Hi friends, I ran a poll on my YouTube channel and 50% people voted that they did not like the interim budget announcement that came out yesterday. I'll discuss with you 6 critical points about this budget that you must be aware. Number 1 is income tax and implications. Number 2 is capital expenditure announcements and its impact on Indian stock market. Number 3 is fiscal deficit announcement and its impact on Indian market. Number 4 is the sectors that the government has been spending in the last 6 to 12 months. Number 5 is the announcement specific to sectors that are going to be in limelight. And lastly, I will also touch upon the stocks that are going to be in focus so that you learn a lot. If you watch this video without skipping, in the 10 to 15 minutes, you are going to gain a lot of knowledge. Before I start deep diving into 6 critical points, you need to understand that this is only a vote on account budget. Is it different from interim budget or a full year budget? Absolutely yes, because a vote on account budget, what government is doing is they are asking for approval for expenditure until the next government is selected. So in this budget, only expenses are discussed and announced. Income or revenues of the government is not announced or discussed in this budget. That is discussed in either the interim budget or the full year budget, right? So the full year budget is going to come only after the government is elected, maybe in the month of July. But still the vote on account budget is very, very important because it is setting the scene of current government and what they are looking for. With that, let's get this video started. First point is around income tax. So I was very, very disappointed personally because there was no relief given to people like you and me who are paying a lot of tax. And if you look at this snippet, you will see that the corporate tax is around 22%, right? But in high income tax slabs, we are paying more than 30% of income tax, right? Now, when corporates are paying 22% tax, please be aware that they are paying this tax only on profits. And before profits comes expenses, there comes depreciation, there comes amortization and many other heads in which companies are very smart to manipulate numbers and make it tax conducive for themselves. So they are able to save a lot of tax. But people like you and me, before our salary hits our account, the tax is deducted. And more importantly, with that tax deducted salary, if we go and buy some things, we have to pay GST on top of it, right? If you want to go and buy a TV or fridge, not only you have already paid tax on your salary, now what you're doing is you are also paying GST on top of that. So in my view, I was expecting some sort of relief on the income tax perspective, but that is not given, right? And if you support my viewpoint here, I would like you to hit the like button on the video and let me know in the comments as well, right? The second point is the around dividends, right? When people like you and me do a lot of research on stock market and invest our money, get some dividends from the companies, we have to pay tax on these dividends as well. And please understand that the company has already paid taxes on these dividends or this income. Only after taxes they are giving the dividends. So there is already tax given by the companies, right? When this dividend is coming to us, we are again paying tax on it. So in my view, this is a double taxation and I do not like this particular idea as well that dividends are taxed. Point number 3 is that the government also announced withdrawal of outstanding direct tax demand from fiscal year 10 and from fiscal year 11 and 15. In my view, this is just a political gimmick because government does not want to piss the people off by continuing to ask for tax, which is very, very old, right? So there is no benefit here for people like you and me. So in conclusion, I am very, very disappointed from an income tax perspective. Let's move to topic number 2, which is capital expenditure announcement and the impact to Indian stock market. Allow me 1 to 2 minutes and you will understand a great deal about capital expenditure and how it is linked with Indian stock market, right? So for that, first of all, let's look at the announcement. The announcement was very simple that for fiscal year 24 and 25, government plans to spend 11 lakh crore rupees of capital expenditure. What does this number mean? Is it more? Is it less? How is it going to impact stock market? For that, let me show you this chart here. You will see that previous year, 23-24, government's proposal was to invest 10 lakh crores in the capital expenditure. And prior to that, 7.3 lakh crores. And prior to that, 5.9 lakh crores. So you will see that in the last 2 years, if you do the maths here, you will see that from 7.3 lakhs to 10 lakh crores is an increment by 37%, right? And year prior to that, from 5.9 to 7.3 lakh crore is an increment by around 23%, right? Also, if I put this in perspective in terms of the percentage of the total expenditure that the government does, because government does not only do the capital expenditure. By the way, capital expenditure simply means the money that the government is spending on building infrastructure, roads, railways and things like that. But government also spends money on, for example, police or on agriculture and many other items, right? So if you look at the capital expenditure as a percentage of the total expenditure, this is a very, very interesting chart. Up until fiscal year 21, it was a very, very flat line. What you see here is that from 22, 23, 24, the percentage of capital expenditure of the total expenditure the government is doing has increased as a very, very massive rate, right? As an impact of that, what has happened in the Indian stock market, let me show you from fiscal year 21 onwards. So if you have a look at this chart, you will see that from fiscal year 21 onwards, after COVID, of course, there was a COVID in between. But if you compare these two green lines, you will see a stark difference between these two. That prior to 2020, the stock market was growing at a flatter rate. But from 21 onwards, you see the big spike in the Indian stock market. We have been in bull run literally in the last 3 years. Now, I'm not saying that the capital expenditure is only one thing. Of course, there are multiple factors that play into it. But what happens is when Indian government spends money on capital expenditure is that people will have more jobs because government is spending money on roads, infrastructure, railways and things like that. It creates job in the economy. When that happens, people have more money. When people have more money, what do? They go and spend the money. And when that happens, companies' profits overall, industry's profits start to go up. And when that happens, foreign institutions, provided your policies are conducive for them to invest, they will come in India and invest their money. And what happens as a result of that? The share market takes off. And this is a beautiful relation that we need to understand. Of course, there are multiple factors. I've oversimplified it to you so that you understand the logic of it, right? Now, if I come back and show it to you that from 10 lakh crores, it is only going to 11.1 lakh crores. That is 11% increment. So government is going very, very tight on the capital expenditure for this year. So does that mean that the stock market will fall now in the next 2 years? Well, no, because market has already budgeted that or baked this into the Nifty level already. Well, Rahul, you're making things up now because you are always talking about good things about stock market. Absolutely not. Let me show you the data. If you see all these rating agencies, prior to the budget that was announced yesterday, they already gave their estimates around the capital expenditure because they are listening to our finance minister, our policymakers, our economists and many other people. And the anticipation was that the capital expenditure budget is going to be somewhere around 10 lakh crores to 11.5 lakh crores. And if you look at Nomura here, they were predicting very close to 11.03 lakh crores, right? So people have already baked in this sort of announcement into the Indian market. And therefore, I don't think there is a problem. Second argument to support my point here is that if you look at this in the last 2 to 3 years, private capex expenditure in Indian economy has been very, very weak. Now, it's not only government that spends money from a capex perspective, private players also do, right? But in the last 2-3 years, government has been spending more because private capex was low, relatively low, but it is now likely to pick up. There is going to be a balancing act here that government's capital expenditure is going to come down, but the private capital expenditure is going to rise, hopefully, and that will also play as a balancing factor. Overall, Indian stock market will continue to remain buoyant, in my view at least, right? I don't know what will happen in the full budget that comes out. Of course, we will do the analysis at that time. And if you want to listen to that video as well, you can subscribe to my channel now. So far, if you're liking this video, hit the like button and let me know in the comments a simple thank you. It will motivate me to do more research for you and come up with good content at zero cost. With that, let's move to point number 3, which is fiscal deficit. So what is fiscal deficit? Fiscal deficit is total expenditure done by Indian government minus the total income. Government's expenditure is always higher than the income. Therefore, there is always a deficit. And for a particular year or a fiscal year, I can call it as a fiscal deficit, right? Simple definition. Now, if I look at the data, what has happening in the last few years is that fiscal year up to year 2019 was very less. After that, fiscal deficit started to go up because of mainly COVID. But even after that, the fiscal year was very high and now it has started to come down. Right now, it is at 5.8% and government's target is to bring it down by 5.1% for fiscal year 24-25, and the year after they want to bring it down to 5%. Why government is doing that? This is very, very important from a stability perspective, from a long-term perspective. Now, how does that impact Indian market from an economy perspective and bonds perspective and stock market perspective? Let me give you 1 minute simple commentary and you will understand all of it. So when fiscal deficit comes down, what happens is that government needs to borrow less money, right? Because they have less deficit to fulfill. This is how government fulfills the fiscal deficit. It's by borrowing, right? So they will borrow less. When they will borrow less, how does government borrow? They borrow by issuing the bonds, right? And if they're borrowing less, then they are issuing less bonds. It means they need to convince less people in the market to buy their bonds. And how does government convince people to buy their bonds? By manipulating the rate or the bond yield, right? So if they're borrowing less, that means bond yield will be less. So that means the bonds have become less lucrative right now. In fact, if you look at the data, the bond yield for the 10-year benchmark bond from an Indian government perspective has dropped to 7% after the announcement happened, right? Now, what is the impact on the stock market? So if the government is borrowing less, then what happens is that there is a lot of liquidity in the market because government is not consuming this money, right? And this money is available for other people and organizations to take it. When that happens, RBI is under very less pressure to increase the interest rate. In fact, they will start to cut down the interest rates, right? And when that happens, companies can borrow more and more money easily. Their cost of borrowing comes down. And this is where banks and NBFCs are going to do much better in the next 2 years because of less fiscal deficit, less borrowing by government, and therefore less borrowing costs for banks and NBFCs. Therefore, they are going to have either higher profits or they are going to pass on these benefits to the customer in terms of reducing the home loan rates and things like that. So overall, from a fiscal deficit perspective, it is a long-term good news, right? And also from a banking NBFC sector perspective, it is a very, very good news. Also from a FII's perspective, if you think about it, FIIs now will be more inclined to invest in India because Indian economy is going to be more stable. It is going to have less debt because we are having less fiscal deficit, right? So overall, from a stock market perspective, it is a very, very good move from a long-term perspective. I like this move because government is not giving unnecessary subsidies and promising a lot of expenditure. They're in fact trying to cut down on the expenditure because they want to bring the fiscal deficit to the lower levels. And if you like this analysis, hit the like button. Let me know in the comments a simple thank you. And let me now move to point number 4. Now in the first half of fiscal year 23-24, where is government spending their capital expenditure? For that, there are primarily 5 sectors that the government is spending money on. So number 1 is road transport and highways. And I've talked about some of those stocks in my member community, YouTube member community. If you're not yet a member of my YouTube member community, you can consider subscribing. You will find the link in the description. But that is number 1, and there is a change by 28% in that particular sector. And this is, I am talking about the actual spend. I will come to the budget announcement in a second, but this is actual spend that has been done by government in 23-24, right? Second sector is railways, and the spending change has been by 61%, right? So huge money has been poured in railways, and you and me all know that's why many of the railway stocks has been rallying like crazy, right? And they will continue because of the announcement they have done. I'll come to that in a minute. I think from a railway sector, I only did one stock, which is IRFC. There's a full video on the channel. Please go and watch it. It is still very, very relevant for you to understand the business model. In fact, if the time permits, I'll play some of the clips from that video into this video. But if time doesn't permit, then you can go and watch that video. Third is defense. Defense has been up by 5.2%, right? From the last year's perspective, but a lot of money has gone into it. Telecom and housing and urban affairs. I've been writing about housing finance companies on my channel. Some of the very good stocks such as Aptus. Not recommendations, please. I'm just talking about fundamentally good stocks. Aptus. Awas is also very good. Star Housing Finance. There are multiple housing finance projects that are doing well. In fact, today after this announcement of budget, Hudco went up by 20%, right? So there is a lot of opportunity in the housing and finance sector that you must go and evaluate. These stocks that I've talked about, please do not take that as recommendations because there is a lot of variables, not just one budget announcement, right? Let's move to the last segment of this video where I'm talking about specific sector and specific stocks. Again, not recommendations, but I will encourage you to do a lot of analysis on those stocks, right? So the first sector was around solar rooftop installations, and the announcement was that 1 crore households are going to get 300 units of electricity free every single month, right? So the companies such as Tata Power, I did analysis on Tata Power as well. They're having very good order book. I can't remember the numbers right now, but they have very good order book around the solar rooftop installations. Please go ahead and watch that video. You will find a lot of information there. Again, not a recommendation. Let me put a disclaimer here. Not a recommendation. Please watch the video. Get some details and make your own decision and do your own research, right? Also in the renewable energy sector, NBFCs are likely to do much better because of 2 reasons. One is the solar spending is going to be there from government's announcements perspective. But more importantly, we talked about the fiscal deficit. So when the fiscal deficit is down, then what happens is that the borrowing becomes easier. So the NBFCs that are operating in this space, so for example, companies like PFC, REC, IREDA, for example, is now rallying like anything. But in my view, it is crazy valuation. I'm not buying that. I'm not investing that. Not an investment advice for you to not do it or do it. That is up to your choice, right? But I did a full video on IRDA just few days back. Please go and watch it. You will understand a lot about that. So also I will do some analysis on REC and PFC as well. Many people have asked for that. But in my view, NBFC sector within the renewable power sector is going to do much better because of reduction in the fiscal deficit as well as reduction in the interest rates that are going to happen in 24-25. Second sector is the railway sector, in which 40,000 Vande Bharat level bogies will be installed, right? That is going to give a lot of boost. 3 major railway corridors were also announced. Again, overall, very, very good story remains there in the railway sector, right? I've only analyzed one stock in railway sector, which is IRFC. You will find the link in the description. But let me know in the comments if any specific stocks you would like me to do further analysis, and I'll come back with full analysis on those stocks as well. Third sector is the EV sector. So from an EV sector perspective, I don't remember that there were any specific numbers that were thrown by finance minister, but overall there is going to be a strong support for the EV sector, right? And again, I did a video on EV sector and my stocks that I talked about. You will find that video as well on my channel, or I will try to link it here as well. So these were the 3 sectors that were talked about, right? Fourth sector was aviation sector. From an aviation sector perspective, I'm not very deep into aviation sector if I'm being very honest, but in the coming days, I will learn more about that sector and do some more analysis. Tourist sector is going to rally like anything because of the announcement done by government, right? Hotel stocks, railway stocks, airline stocks might do better, right? Again, no specific recommendations there. Focus on biomanufacturing as well. For example, biodegradable plastics, biopolymers. I have to dig deeper to find some quality stocks in that area as well. I have not explored that area a lot, right? Technology-led research and innovation, that was very, very big announcement as well. 1 lakh crore for 50-year loan without any interest is amazing. We need to find some companies in that sector as well, right? Overall, I like the budget from an economy perspective, from Indian growth perspective, but from an income tax perspective, it was a major disappointment for me, right? I hope you found a lot of content in this video, which is very, very useful. And I've given you very independent, unbiased, my analysis. I would love to know from you, what is your view on this budget? Let me know in the comments your analysis and your one-liner. I would love to read that. With that, I'll see you in my next video. Until then, keep rocking.